it's very important to get in a global perspective. Geoffrey Dennis, independent emerging markets commentator, joins us right now on the show. Jeff, good morning, and good evening to you rather. Thanks so much for joining in. This is not entirely unexpected, but do you reckon that the fact that both the sides have sounded de-escalatory, if I can use that term, in their comments, would only augur well for the sentiment around markets?
Oh, yes, I think so. I think it's compared to where we were 24 hours ago, I think it's quite a surprise, actually, that we've seen what we've seen in terms of a fairly modest Iranian response, clear evidence from the Iranian foreign minister that this is all they're going to do in terms of a response at the moment to the assassination of the general, and obviously a relatively, should we say, dovish set of comments from President Trump. So I think it's a big surprise, personally, although I'm not a political analyst, far from it. But at the end of the day, this is all good, I think, because the markets will be in a position, if they want to assume that this is it for the time being between U.S. and Iran in terms of any potential conflict, and we'll get back, as you've just said, to get back to business.
So what would getting back to business mean, Jeff, with an assumption that geopolitics is not top of the mind and crude prices have also seen a bit of a cool off? Would you reckon there is a better tilt for emerging markets to do more in the near term, depending, of course, individual market functions as well? But would EMs have a better chance because of this cool off, or would you believe that DMs are a better bet right now?
I think it will be good for EM on a relative basis. I mean, my view has been all along that it's a fairly narrow path to emerging markets outperforming developed this year because, you know, the big risk for emerging markets and their potential underperformance is if the global economy slows right down and you end up with a U.S. recession, in which case you'll get a stronger dollar, you'll get money coming back to the U.S., and typically EM underperforms in a recessionary environment. So clearly the spike in oil prices, given that it's not lasted for long at all, just a few days, I guess doesn't particularly change the outlook at the margin for the U.S. economy. But the window, or the path, perhaps I should say, towards a EM outperformance is really in terms of soft U.S. growth without it being recessionary, the Fed being supportive, bond yields staying relatively low, and ultimately a weaker dollar, which I think is overvalued, which would then push money towards overseas. Now, today you've seen the dollar strengthening a little bit, but overall I think we may be back on that as a central case, with I think the big risk being still an outright U.S. recession. Whereas if, of course, the politics had got really bad and you saw really significant response by Iran and then retaliation again by the U.S., say the closure of the Straits of Hormuz, you could have seen oil prices go to $80, $90, $100 a barrel. And that would have been much, much more risky for the global economy and for financial markets and for EM. So this is a good resolution from what we know at the moment, and that narrow path towards some sort of EM outperformance, maybe back on track again now.
Just one final question, Jeff, on that, the very point, crude, that you mentioned. What's your best case estimate? Would you believe that if things stand as they are, then the $70 per barrel mark that we had is a near-term top of sorts, and we may actually head lower after the kind of pullback that we've already seen in crude prices overnight?
I don't think we're going to head lower. I suspect where we are now is I mean, we may head marginally lower. I suspect the way you look at it now is we're back in the middle of the trading range. Let's call it $60 to $70 for Brent. And I think to go above $70 on a sustainable basis now, which obviously at the margin would be a negative for India because of all the oil imports that you have to do. I think that only happens now in the event the politics deteriorates once again. I think the global economy probably can't sustain oil prices on their own. The global economy cannot sustain oil prices above the $70 level. So the only way you go above 70 is either there's a massive or a significant cut in OPEC output, which seems unlikely at the moment beyond what's already been agreed, or you get a further escalation of political tension. So I'm inclined to think that oil prices are back in the trading range, perhaps towards the middle. There could be some testing of the downside in the short term. It depends what the economic numbers are going to be over the near term. And as ever, of course, it depends on what the dollar does. If you were to get a big sharp fall in the dollar moving forward from here on weaker U.S. growth, that could push the price of oil higher. But right now, it looks like the risk premium attached to oil because of the politics is being eliminated pretty quickly, and markets look reasonably well positioned. Oil's going to stay pretty stable, and obviously that's one less thing for the Indian market to worry about.
Yes, indeed, Jeff. Thanks so much for speaking to us this morning, and have a great evening and a good night to you.